Usually when we talk about a medical diagnosis, there's this comforting expectation of precision, right?
Right, yeah, like it's binary.
Exactly. You break your arm, you get an X-ray, and the doctor just points to that jagged white line. It's broken or it's not broken, it's clean.
Hmm.
But when you step into the future of global finance, that X-ray machine just kind of shatters. I mean, what happens when the money in your bank account is tied directly to your face or like your heartbeat?
Right, or an artificial intelligence that's deciding in real time if you're compliant.
Yes, exactly. Today, we're looking at a blueprint of exactly how that happens and, well, the pretty much impossible choice it's going to force every single one of us to make with our money.
Yeah, it is the absolute definition of diagnostic muddy waters, I mean. But the underlying structures are already being built. What we're exploring today really maps out the fault lines of a financial earthquake.
Well, welcome to the deep dive. Today, our mission is to unpack a really fascinating, honestly incredibly relevant academic working paper. It's from May 2026 titled A Tale of Two Investors, Bifurcated Investment Strategies for a Post-Labor World.
Authored by M.R. Williams, right,
Yeah.
from Governor State University.
That's the one. And the core premise here is something that affects you directly.
Hmm.
I mean, we're looking at this potential near-future scenario where massive foundational technological shifts are on this total collision course with changes in the labor market.
Mm.
And this collision, it's going to force anyone who invests. And that means you, listening right now, whether you're managing a multi-billion-dollar pension fund or just looking at your personal 401k or a modest brokerage account, it forces you to choose between two completely different diverging financial paths.
And, the sheer novelty of Williams's approach here, it really can't be overstated, because in academic literature, you usually have specialists staying rigidly in their own lanes.
Like totally siloed.
Exactly. You've got cryptographers writing exclusively about digital money, economists isolating labor markets, ethicists debating biometrics.
And finance professors just, tweaking portfolio theory over in the corner.
Right. But this paper, it's the first peer-reviewed synthesis to integrate 8 distinct fields into one cohesive analytic frame.
Wow.
Yeah, it pulls together central bank digital currency design, biometric ethics, the post-labor economy, and even a classic 1970s sociological framework on human behavior, just pulling it all into a single comprehensive map of our financial future.
It's massive. Now, before we really start turning the gears on this, we do need to make something perfectly clear. This paper touches on some highly debated, like extremely politically charged topics.
Oh, absolutely.
We're talking about the mechanics of digital surveillance, the centralization of central banking, universal basic income, the potential displacement of the human workforce. I mean, heavy stuff.
It is, and that's a crucial disclaimer. In this deep dive, we are absolutely not taking sides on any of these issues.
Yeah, not all.
Our goal is strictly to explore the architecture of this potential future and the investor typologies, exactly as the author has laid them out.
Yeah.
The paper itself remains strictly nonpartisan, treating these developments as an analytic problem, a set of contingencies. And we're doing exactly the same thing. We're here to map the territory, to show you how the pieces fit together, not to tell you, which flag to fly or which ideology to adopt.
So let's start mapping. The paper introduces what it calls 2 macro conditions. And if these happen simultaneously, they split the investment world right down the middle. So condition 1 is the maturation of the ADCD architecture.
Right, that's the acronym the author uses.
Yeah, ADCD. It stands for artificial intelligence, biometric identification, central bank digital currency, and the digital financial system.
Right.
And, thinking about this, it's like upgrading a city's entire plumbing, electrical, and road systems all at the exact same time. You might not see the pipes buried under the concrete, but it completely changes how the water flows, who gets it, and who controls the valve.
That plumbing metaphor is perfectly apt, actually. To really grasp the magnitude of the shift, we can't just look at the acronym as a whole. We have to look at the mechanics of each of those 4 legs, the A, B, C, and D, because they aren't developing in isolation, They're co-evolving.
Okay, let's start with the A, artificial intelligence. But the paper makes a very specific point to distinguish this from the chatbots or the large language models we're all used to playing around with on our phones, right? I mean, we aren't just talking about a computer writing a polite email to your bank manager.
Far from it. No, Williams is talking about AI moving into what are called agentic workflows.
Agentic workflows.
Right, autonomous decision systems within the core of global finance. See, a large language model, it predicts the next word in a sentence based on training data. But an agentic AI system has an objective function. It can access external APIs. It can run Monte Carlo simulations to balance a portfolio. And it can execute trades completely autonomously.
Without a human saying yes or no.
Exactly. Without human oversight. We're talking about AI models executing split-second credit scoring based on alternative data, managing real-time regulatory compliance across borders, actively reallocating capital. It's AI as the operational engine of the economy, just entirely replacing the back office and middle office human infrastructure.
Which is wild to think about. And that brings us to the BBRIVE biometric identification.
Yeah.
The author notes this is totally graduated from, like, the airport border control line or law enforcement databases into routine, everyday consumer payments.
Yeah, absolutely everywhere.
We're talking about face scans, fingerprints, but also, and this blew my mind, behavioral biometrics.
Yeah.
Which I just find wild. I mean, explain how behavioral biometrics actually anchor to a financial wallet. Like, what does that even mean?
So behavioral biometrics measure the unique patterns in how you physically interact with your devices.
Okay.
It's the specific cadence of your typing, the angle at which you hold your smartphone on the subway, the pressure of your swipe, your gait if the device is in your pocket.
Wait, really? Like how I walk?
Yes, exactly. The technology has advanced to the point where these passive signals are just as unique as a physical fingerprint. So in the ABCD architecture, these biometric markers are anchored directly to your digital wallet and the settlement layer of the financial system. You don't just possess a password anymore. Your physical and behavioral being is the cryptographic key.
That authorizes the movement of capital.
Right.
So my phone knows it's me because of how hard I attack the screen, and that authorizes a transaction.
Exactly. It's continuous authentication.
That is just staggering. Okay, and then we have the C, which honestly feels like the heaviest piece of this entire puzzle.
Yeah.
Central bank digital currency, or CBDC. Now, I want to be really clear for anyone listening who hears digital currency and immediately thinks of Bitcoin or like crypto speculation. This is fundamentally different, right?
Oh, it's the polar opposite of Bitcoin in terms of its structural philosophy.
Okay, how so?
Well, Bitcoin is decentralized, it's pseudonymous, and it operates entirely outside of state control. A central bank digital currency is programmable, identity-linked, settlement layer money that is issued directly by the state. Right. It's a digital liability of the central bank itself. And the paper cites an astonishing statistic from the Atlantic Council. In 2026, 146 jurisdictions, which represents over 98% of global GDP, are currently exploring or actively developing CBDCs.
98% of global GDP. That is effectively the entire planet.
Yeah.
But let's dig into that word you used, programmable. What does it actually mean for money to be programmable? Because, I mean, cash isn't programmable. The $20 bill doesn't care what I spend it on.
Exactly. Physical cash is bearer agnostic. If you have it in your hand, you can spend it. But programmable money relies on smart contracts.
Right, the code.
Yes, blocks of code embedded directly into the currency itself. This means the money can be encoded with logic that dictates when, where, and by whom it can be spent.
Okay, give me an example of that.
Sure. So, for example, a central bank could issue stimulus funds via a CBDC, but they attach an expiration date to it to force immediate spending in the economy.
Oh, wow. So if I don't spend it in 30 days, it just vanishes.
Exactly. Or they could program the funds so they cannot be used to purchase certain restricted items. Or they can instantly deduct taxes at the point of sale without any intermediary. The rules of the economy are literally written into the money itself.
Okay, that is a massive paradigm shift.
Yeah.
Just huge. And finally, we have the digital financial system. This is the integrated set of rails connecting all the other three. We're talking about tokenized real-world assets, embedded finance. This is the actual digital pathway where this new programmable money moves, right?
That's right, the infrastructure.
So my big question is, why do these four have to be integrated? Why can't we just have, agentic AI over here doing its thing for hedge funds and a CBDC over there for government payments? Why is the author so convinced they have to fuse into this single architecture?
That is actually the core friction point of the entire first half of the paper. It's all about mutual reinforcement.
Okay.
The author argues that these technologies are inherently starved for what the others provide. Think about the mechanics of it. An AI-driven credit and compliance system, it needs to ingest massive continuous streams of perfectly authenticated, identity-anchored transaction data to be accurate and to avoid fraud.
Right.
Where does it get that pristine data? From the CBDCs and the biometrics.
Because if the AI is analyzing, like, fake data or synthetic identities, its credit models completely fall apart.
Precisely, it becomes useless. But conversely, a central bank cannot roll out a programmable CBDC safely to retail users without incredibly robust digital identity verification. They have to prevent money laundering and ensure compliance.
Hence the need for biometrics.
Exactly. And then the biometrics cannot be monetized or seamlessly operationalized in global finance without the frictionless, instantaneous rails of the digital financial system.
Right.
So they are theoretically separable in a vacuum, sure, but in practice, policy actors and industry giants are co-designing them to interlock. They form a single, unified nervous system for the economy.
I mean, if you just look at your own daily routine for a second, it makes sense. How often do you already use your face to unlock your banking app? Or double-click a side button to pay for a coffee using a stored digital card?
All the time.
Exactly. The B and the D legs, the biometrics and the digital financial rails, they're already touching your daily life. The pipes are being laid right beneath our feet. We just haven't turned the water on full blast yet.
And that maturation of the ABCD plumbing is just condition one. The paper argues that for this massive investor bifurcation to truly trigger, a second macro condition acts as the catalyst.
Right, the post-labor and universal basic income response.
Yeah.
So the paper posits that AI and advanced robotics might displace a huge fraction of the labor force.
Oh.
And because of this, serious institutional actors are considering universal basic income, or UBI, or a universal basic dividend, as an actual necessary policy response. Now, I have to push back hard here. We hear this every single time there's a tech boom. People have been predicting the end of work since, well, the Industrial Revolution.
Sure.
When the mechanical loom was invented, people swore there would be no more jobs. When computers hit the office, people said the exact same thing. Humans always find new things to do. Is this paper just being alarmist?
That is a very fair critique, and Williams completely anticipates it. The paper is incredibly careful to treat this strictly as a contingency, not a definitive, guaranteed forecast.
Okay, so it's an if-then scenario.
Exactly. The empirical literature is, as Williams puts it, genuinely contested. He explicitly cites labor economists like James Besson and David Autor, who advance very strong, historically grounded reasons to expect the economy to adjust over time.
Right.
They argue that automation replaces tasks, not necessarily entire jobs, and that lowering the cost of production increases demand, which creates new jobs we just can't yet imagine.
Exactly. I mean, I can't imagine a social media manager job existed in 1995, right? So why is this time supposedly different?
The counter-argument, which Williams also explores, is the nature of the automation itself. The mechanical loom replaced physical muscle and repetition,
Right.
but agentic AI replaces cognitive labor, pattern recognition, and decision-making. If AI can write code, draft legal briefs, diagnose patients, and manage supply chains, the timeline for humans to reskill into newly created cognitive jobs might just be way slower than the pace of displacement.
Okay, so it's a speed problem.
A speed and a scale problem, yes.
Eh.
The paper does not claim to know which side of that debate is definitively right, but it argues that the probability of severe, even if it's temporary, widespread displacement is high enough that governments will likely deploy a UBI response to maintain social stability and consumer demand.
That makes sense.
And as an investor, you don't only plan for certainties, you allocate capital based on high-impact probabilities. If governments deploy UBI, how do they distribute it efficiently to millions of people in real time?
Oh, I see where this is going. They use the programmable CBDC and biometric identity rails.
Exactly. The UBI becomes the killer app for the ABCD architecture. It forces mass adoption. If you want your basic income, you have to download the central bank wallet and you have to scan your face.
Wow. That is the catalytic event right there. If both of these conditions hold, if the ABCD architecture matures and we see a post-labor UBI transition forcing mass adoption, the investable universe effectively splits in two.
It bifurcates completely.
So we have the new pipes laid, the water is turned on via UBI, and everyone basically has to make a choice.
Yeah.
And this brings us to the core of the paper, the participant versus the resistant archetypes.
Yes.
The author claims investors will divide into two distinct camps based on how they interact with this new reality. Let's start with the first camp, the participant.
So the participant is an investor who allocates their capital toward the build-out of the ABCD architecture. They expect the system to become the dominant infrastructure of the new economy, and they want the financial rewards of being exposed to it. They are funding the machine.
Right. And then the second camp is the resistant. This investor actively screens out the architecture entirely. They look at this convergence of AI, biometrics, CBDCs, and digital rails, and they just say, no, thank you. I will not put my money there regardless of the potential profits. But to really explain how people navigate this choice, Williams pulls in a framework from 1970 by an economist and sociologist named Albert Hirschman. The book is called Exit, Voice, and Loyalty. How does a 50-year-old organizational theory apply to futuristic tech investing?
It maps beautifully, which is really the genius of applying it here. See, Hirschman was originally looking at how humans respond to a decline in organizations, say a deteriorating corporation, a failing state, or a shifting institution.
Yeah.
He argued that when you're part of a system that is fundamentally changing in a way you might not love, you have three options. You can remain loyal and just go along with it. You can use your voice to try and change it from the inside, or you can completely exit the system. And Williams takes this framework and applies it directly to how capital will be allocated during the ABCD transition.
Okay, let's break those down.
Yeah.
Within that participant camp, the ones investing in the tech, we have two subgroups based on Hirschman. We have participant loyalty.
Participant loyalty is passive allocation.
Yep.
This is the investor who just buys the broad market index funds, the tech-heavy ETFs, and rides the wave.
Yeah.
They do not engage with the ethics, the privacy implications, or the design of the system. They simply acknowledge that this is where the global economy is heading, and they want the beta, the broad market returns from the new infrastructure.
Which, if we are being totally honest, is almost everyone. If you have a 401k right now and you're holding a target date fund or an S&P 500 index, you are a loyalist by default.
Yes.
You are funding whatever the biggest companies are building, which right now is heavily leaning into this AI and digital infrastructure.
Mm-hmm.
You don't have to actively wake up and choose to be a loyalist. It is just the default setting of modern investing.
That is absolutely correct. Inertia makes you a loyalist. But then we have participant voice.
Right, the people who want the profits, but also have opinions on how the system is built.
Exactly. Participant voice means you are investing in the tech, but you are actively using your shareholder power through proxy voting, board engagement, or public pressure to shape its design.
Interesting.
This is analogous to modern ESG investing, but targeted at tech architecture. Maybe you buy massive blocks of shares in a biometric hardware company, but you use your voting power to force them to adopt stricter on-device processing so personal data doesn't go to a central server.
Oh, I see.
You're inside the system, you're funding it, but you're using your voice to moderate its more extreme edges.
Okay, so that covers the folks who are in this system, either passively riding it or actively tweaking it. But what if I look at this entire architecture? The programmable money, the biometric surveillance, the agentic AI, and I just decide the whole thing is fundamentally flawed.
Right, the third option.
Yeah, what if I want to use Hirschman's third option, exit? I mean, it is really easy to say on in a discussion that you won't invest in bad things, but how do you systematically avoid the biggest technological boom in history in a modern portfolio?
That is where the paper transitions from theory to actual financial mechanics. To achieve exit, these investors use what Williams calls the ABCD aversion screen. And this methodology is directly analogous to traditional socially responsible investing, or SRI, which often uses negative screens.
Right. SRI has been around for decades. The classic examples are those sin stock exclusions, right? You tell your mutual fund manager, I don't want a single penny of my money in alcohol, tobacco, gambling, or weapons.
Mm-hmm.
The manager runs a screen, filters those sectors out of your portfolio, and invests in what's left.
That's precisely. Williams proposes that the resistant investor will use an ABCD aversion screen in exactly the same way. But instead of screening for tobacco, they're screening for technological complicity. And this screen operates on 4 specific criteria to figure out exactly what gets thrown out.
Let's unpack the mechanics of that screen. The first criterion is architecture complicity.
This asks the fundamental question. Is the company directly involved in building or maintaining any of the 4 ABCD legs?
Right.
Are they training the foundational AI models? Are they manufacturing the biometric facial scanners used at checkout? Are they coding the distributed ledgers for the central bank? If yes, they hit the screen and they're out.
But it's rarely that black and white, right?
Yeah.
Which brings us to the second criterion, the materiality threshold. Because a company might have a tiny side project in AI, while another company's entire lifeblood is harvesting biometric data.
Exactly. The materiality threshold is a revenue share or a role significance test. If a massive agricultural company uses a tiny bit of AI to predict weather patterns, they probably pass the screen.
Makes sense.
But if a company derives 30% of its revenue from selling biometric data to financial institutions, they cross the materiality threshold and are explicitly excluded.
And that bleeds into the third criterion, categorical scope. which deals with conglomerates. I mean, if you have a massive multi-trillion-dollar tech company that makes the smartphone in your pocket, runs the cloud servers for half internet, but also builds the underlying infrastructure for a CBDC, how do you handle that? Do you dump the whole stock or just try to avoid that specific sector?
That is the hardest part for the resistant investor, and it really depends on the fourth criterion, the stringency setting.
Okay, the dial.
Yes. Think of it as a dial you turn on your portfolio. You can set it to intermediate, where you tolerate conglomerates as long as the ABCD stuff is a minor division. Or you can set the dial to maximum stringency, where any association, any complicity whatsoever means the entire conglomerate is purged from your portfolio.
Wow. So if I'm building this resistant portfolio and my dial is turned up, I am actively cutting out the most profitable, fastest growing tech giants in the entire world. I'm kneecapping my own potential returns.
Yeah.
So what is my actual motivation here? Because honestly, missing out on the next AI boom sounds financially suicidal. Who actually does this? Why would rational people pass up this wealth-generating engine?
That is arguably the most fascinating behavioral aspect of the paper. Williams outlines 5 distinct resistant motivational profiles. These are the calculated, deeply held reasons why highly rational actors might look at this architecture and just say, no.
I want to dig into each of these because they are so distinct from one another. The first profile is privacy and civil liberties.
This is the surveillance opposition. These investors are deeply concerned about data sovereignty and the erosion of the Fourth Amendment or its global equivalents. They look at a world where every single transaction, every cup of coffee, every train ticket is linked to a biometric scan and tracked on a central, immutable ledger. They see a civil liberties nightmare where the state or corporate monopolies have panoptic visibility into human behavior. They refuse to fund the infrastructure of a surveillance state on pure principle.
It's the ultimate privacy advocate.
Yeah.
But the second profile comes at it from a completely different angle, religious conscience. And this one really caught my attention because it drives real institutional capital. We're talking about faith tradition commitments and eschatological concerns.
Yes, and it's a very powerful market force. Some religious groups look at a mandatory identity-linked cashless payment system and see striking parallels to end times prophecies.
Oh, yeah.
In certain Christian eschatologies, for instance, there is a deep fear of a centralized system where you cannot buy or sell without a specific mark or digital identification. Regardless of whether one shares that specific theology, for those investors, those beliefs mandate a strict, uncompromising categorical exclusion. They cannot participate without violating their core religious tenets.
That makes total sense. I mean, if you believe funding a technology is literally funding the apocalypse, you don't care if the stock is up 20% this quarter.
Exactly.
The third profile is libertarian Austrian. Let's pause and actually explain what Austrian economics means in this context, because it's a very specific worldview.
Right. So the Austrian School of Economics is fundamentally skeptical of state intervention in the economy, particularly concerning central banking and fiat money. Adherents believe that central banks manipulating interest rates and controlling the money supply create artificial booms and catastrophic busts. They advocate for sovereign money, decentralization, and hard assets that cannot be printed or programmed out of thin air. For an Austrian investor, a programmable CBDC represents the ultimate, terrifying evolution of state control over money. It allows the state to dictate economic behavior at a granular level. They view it as inherently unstable, coercive, and economically destructive in the long run.
So they are opting out because they think the economic fundamentals are just toxic.
Precisely.
What about the fourth profile? Geopolitical.
This is a pure risk calculus, often applied by sovereign wealth funds, family offices, or international actors. They fear foreign sovereignty risks. Well, imagine a scenario where a dominant superpower, say the US or China or a European consortium, controls the foundational patents and infrastructure for the global ABCD architecture.
Okay.
If you are an investor or an institution in a smaller nation and you fully integrate your wealth into that system, you are subjugating your financial independence to that superpower. They can freeze your assets with a keystroke. The geopolitical resistant opts out for jurisdictional diversification to ensure their wealth isn't held hostage by foreign policy.
Wow, that's incredibly pragmatic. And finally, the fifth profile, operational skepticism, which feels like, I don't know, the most relatable of the bunch in some ways.
It is entirely pragmatic. These investors just look at the sheer mind-boggling complexity of integrating global AI, real-time biometrics, and programmable digital money, and they doubt it will actually work.
Yeah, like it's just going to crash.
Exactly. They aren't opting out for moral or religious reasons. They just think the system is fragile. They worry about systemic cybersecurity threats, catastrophic hacks, quantum computing breaking the cryptography, or just simple cascading software failures. They think the new plumbing is going to burst, and they don't want their money in the pipes when it does.
I just love how the paper breaks this down. If we pull back and look at the bigger picture, opting out isn't just about being a Luddite who hates computers and wants to live in the woods,
Right.
It is a highly calculated philosophical, religious, or practical rejection of a new system. It's a principled stand, or a risk management strategy, manifesting as a financial portfolio.
Exactly. It's capital allocation as a form of protest and self-preservation. But how you manifest that resistance creates yet another division, which brings us to the two distinct types of resistance.
Let's get into that. Within this resistant camp, Williams identifies two subtypes. The first is RAA, which stands for resistant A or avoidance only.
The RA investor is mathematically going to be the larger group of the two. They apply that ABCD aversion screen we just walked through. They filter out the complicit tech companies, but otherwise they hold a completely standard traditional portfolio.
Right.
They might buy standard real estate, traditional municipal bonds, consumer staples, healthcare equities. They are essentially making a compromise. They're saying, I have to live in this modern world. I cannot escape the architecture completely, but I decline to actively fund its creation. It is a single behavioral move.
Exclusion.
So they just don't buy the tech stocks. But then you have the RB investor, resistant B, which is avoidance plus carry forward. The paper notes this group is numerically smaller, but behaviorally much more demanding and intensive. They don't just screen out the tech. They construct highly specialized portfolios specifically designed to preserve their wealth across what the paper ominously calls adverse end states.
Now, I have to stop here. Adverse end states. What exactly are they preparing for? How bad could a technological transition actually get for someone just holding traditional stocks or dollars? It sounds like we're bordering on sci-fi dystopia.
It does sound extreme until you look at the mechanics of monetary history.
Okay.
That is the multi-trillion-dollar question the RB investor is trying to answer. To explain the rationale, Williams introduces the confiscation and asset continuity spectrum. You have to understand that when a society changes the fundamental nature of its money, which is exactly what moving from analog fiat to a programmable CBDC and ABCD system is, the people holding the old money or traditional legacy assets face an enormous structural risk.
Because the old money might not be compatible with the new system.
Precisely. The paper outlines 5 plausible end states for legacy assets during this massive transition, ranging from most favorable to absolute catastrophe.
All right, walk me through this spectrum. End state number 1 is full continuity.
This is the best case scenario for legacy holders. The new ABCD system rolls out, but your old bank deposits, your traditional equities, your analog cash, they seamlessly coexist. They maintain their full parallel value, and you can trade between the old system and the new system without friction.
Okay, that's the dream. End state 2 is soft conversion.
Here, the state wants everyone on the new system, so they incentivize you to move your assets.
Right.
Maybe you get a slight tax break or a preferential exchange rate if you voluntarily convert your traditional analog dollars into the new programmable CBDC. It's a nudge, it's voluntary, but the writing is on the wall.
Got it. End state 3 is where the friction really starts, I assume. Selective haircut.
Yes, this is a forced structural conversion where you lose some of your wealth. Imagine the government mandates that legacy assets must be ported over to the new biometric ledger, but they offer you an exchange rate of 90 cents on the dollar.
Oh, ouch.
Or perhaps large legacy accounts are aggressively taxed during the transition to fund the new infrastructure. You don't lose everything, but the state takes a cut of your wealth simply for the privilege of bringing it into the new era.
Okay, that hurts. End state 4 is categorical prohibition.
This is where it gets highly adversarial. The state declares that legacy assets or alternative forms of analog money are now legally prohibited to hold or transact with outside the ABCD system.
Wow.
You must surrender them, convert them under strict penalty, or face criminal charges. The old system is outlawed.
When finally, end state 5, total extinction.
The absolute worst-case scenario. Legacy assets, old currency notes, unregistered paper wealth, assets that refuse to integrate with the biometric identity layer are simply voided.
Just gone.
They are declared unrecognized by the state and become completely worthless overnight. Your wealth is extinguished because it exists outside the approved ledger.
Okay, I have to jump in here. Categorical prohibition. Total extinction. I hear this and I think, come on, the government is not going to just delete my 401k because I won't use a face scanner. It sounds incredibly alarmist. Isn't the author stretching credibility here?
That is the very natural reaction. But what is so compelling about this section of the paper is how Williams grounds this spectrum in hard historical precedent.
Okay.
He is proving that this isn't science fiction at all. It's history repeating itself. Whenever monetary regimes shift, wealth confiscation or destruction is actually the historical norm, not the exception. Williams walks through 5 distinct historical analogs where governments dramatically altered the monetary reality, leaving legacy asset holders absolutely devastated.
All right, let's run through these because this is where the theory really hits reality. 1933, the U.S. gold prohibition. Explain exactly how that worked.
In 1933, amid the Great Depression, President Franklin D. Roosevelt issued Executive Order 6102. It literally made it a criminal offense for American citizens to hold private monetary gold.
Criminal offense.
Yes. You were compelled, under threat of a massive $10,000 fine and up to 10 years in federal prison, to surrender your gold coins and bullion to the Federal Reserve in exchange for paper money at a fixed rate of $20.67 an ounce.
Wow.
And shortly after confiscating it, the government revalued gold to $35 an ounce, effectively wiping out a massive chunk of the purchasing power of the citizens who complied. That is a categorical prohibition enforced by prison time, and it happened right here in the United States.
That is wild to think about. The government just redefined what was legal to own, and if you didn't play along, you went to jail. What about 1948, occupied Germany currency reform?
So, after World War II, the German economy was in ruins and hyperinflation was rampant. The Allied authorities instituted a sudden, brutal currency reform. The old Reichsmark was converted to the new Deutschmark.
Okay.
But it wasn't one-to-one. For large balances, the conversion rate was incredibly punitive, sometimes wiping out 90% of the nominal value of savings.
Right.
It was a massive state-mandated destruction of legacy wealth to restart the economic engine.
Wow. 1991, post-Soviet transitions.
When the Soviet Union collapsed, you saw hyperinflation, the complete breakdown of the ruble, and rapid, chaotic privatization. The life savings of ordinary citizens, held in state banks, just evaporated. The currency they held simply ceased to have purchasing power in the newly formed capitalist markets. It was a form of total extinction of the old asset value.
2002. The Argentine corralito. And this one is visceral because, there's footage of people literally banging on the doors of banks.
Exactly. Argentina was facing a massive debt crisis and capital flight. The government instituted the corralito. They froze bank deposits. They broke the peso's peg to the U.S. dollar. People could look at their bank statements and see their money, but they were legally prohibited from withdrawing it or moving it to safety. When the funds were eventually released, the currency had violently devalued. Your money was held hostage while it burned.
And a relatively recent one, right in the heart of Europe, 2013, Cyprus bank haircuts.
Right. During the European sovereign debt crisis, the banking sector in Cyprus collapsed. To secure a bailout from the EU, the government of Cyprus did something unprecedented. They levied a selective haircut, directly on uninsured deposits over 100,000 euros.
They just took it.
They didn't ask. They just went into the bank accounts over the weekend and confiscated a percentage of the wealth to recapitalize the failing banks.
The aha moment here is that the government doesn't need to send police to your door to take your wealth. They just change the definition of money and leave you stranded on the wrong side of the ledger.
Precisely. So when the RB investor is preparing for an adverse end state, they aren't wearing a tinfoil hat. They are looking at empirical financial history. When monetary regimes change, legacy capital often gets trapped, taxed, or confiscated. The RB investor assumes the transition to an ABCD architecture will be no different.
Which brings us to the actual portfolios. How do these different archetypes, the participants and the resistance, actually allocate their capital today? What are they buying?
Williams identifies a 10-technology investable core. These are the assets the participant cohort joyfully allocates capital toward. First, obviously, are the 4 ABCD legs themselves, the companies building artificial intelligence, biometric identification hardware, central bank digital currency infrastructure, and digital financial system platforms.
But those 4 legs can't operate in a vacuum. The paper outlines 6 supporting technologies required to actually build the architecture out. Let's dig into these. First is DLT and smart contracts distributed ledger technology.
Yes, these are the foundational blockchain-like database layers. They allow for the programmable execution of contracts without human intermediaries. It is the code that allows the CBDC to execute a transaction only if the biometric scan matches the AI credit score.
Right. Next is real-world asset tokenization. Explain how this actually works.
Tokenization is taking a physical, illiquid asset, like a commercial skyscraper in Manhattan, or a piece of fine art, or even a fleet of cargo ships, and representing its legal ownership as a digital token on a distributed ledger. Instead of one person owning a $100 million building, 1 million people can instantly trade 100 fractions of that building on their phones, settling instantly via the CBDC.
It makes everything liquid. Then we have embedded finance.
This is the invisible plumbing of lending and payments. It's when you buy something on an e-commerce platform or a social media app, and you're offered a loan, insurance, and settlement right at checkout without ever visiting a bank or opening a separate app. The finance is entirely embedded in the non-financial platform.
Cloud and edge computing.
You cannot run global AI and real-time biometric verification for billions of people without massive computing power. Cloud refers to the giant server farms, but edge is crucial. That means processing the biometric data locally on the scanner or the smartphone to reduce latency and bandwidth.
Big data and predictive modeling.
The algorithms that make sense the tidal wave of biometric, behavioral, and financial data being generated every millisecond. This is what feeds the AI.
And finally, number 10, privacy-preserving cryptography. Now, I want to pause right here. Let's look at the Investor Class X technology matrix from the paper, because there's a brilliant irony here.
Oh, absolutely.
The matrix shows who is buying what. Participants are heavily buying the AI and the biometrics. Resistants are completely excluding them. But when we look at that 10th technology, privacy-preserving cryptography, both the RA and the RB resistance might heavily invest in this. So even if you are resisting the tech, you are still investing in tech to fight the tech. You're building rogue pipes under the city.
That is exactly the irony, and it's a necessary survival strategy. If you are deeply concerned about a biometric surveillance state, what's your countermove? You invest in technologies that blind the surveillance. You invest in zero-knowledge proofs, cryptographic privacy tools, and secure encrypted communication networks.
Stop for a second. Zero-knowledge proofs. We hear this term thrown around in cryptography, but how does it actually work in this context? How do I prove who I am without giving the system my data?
Right, so think about the classic analogy of a bouncer at a bar.
Okay, yeah.
Normally, to prove you're over 21, you hand the bouncer your driver's license. The bouncer sees your birth date, but they also see your home address, your full name, your organ donor status, and your exact height. You gave them way more data than they needed.
Oh, right, all that extra stuff they don't actually need.
A zero-knowledge proof is a cryptographic method where your digital wallet communicates with the bouncer scanner and mathematically proves the statement, "I am over 21, is true, without revealing your birth date or any other piece of information. The bouncer gets a simple yes or no.
That is brilliant. It verifies the truth without revealing the underlying data.
Exactly. The resistance needs its own infrastructure, and zero-knowledge proofs are a foundational pillar of that. But for the RB investor, the one deeply worried about historical confiscations and adverse end states, they go even further. They utilize what the paper calls exit vectors to completely insulate their wealth.
And there are 5 categories of these exit vectors. How do they actually preserve their wealth when the system changes?
First, hard assets. These are things you can physically touch, things that hold intrinsic human value outside the digital realm and cannot be deleted by a server crash or a government decree. We are talking about physical gold and silver, physical real estate, and crucially, productive farmland.
Right.
If the digital economy collapses, humans still need to eat.
Second, non-custodial digital assets.
This is critical. It means holding your own cryptographic private keys. You're not keeping your digital wealth on a centralized exchange like Coinbase or in a traditional bank where they hold the keys. You hold the seed phrase yourself.
Because if you hold the keys,
no central authority can freeze your account or confiscate your wealth with a keystroke because they literally do not have the mathematical ability to move it.
Third, jurisdictional diversification.
This is playing global chess, spreading your wealth across multiple sovereign countries and legal systems. If one monetary regime turns hostile and mandates a categorical prohibition of legacy assets, your assets safely domiciled in a neutral, non-participating jurisdiction remain untouched.
Fourth, parallel payment networks.
Investing in or actively using alternative peer-to-peer settlement rails that operate completely outside the mainstream central bank and commercial banking system. Think of decentralized privacy coins or Hawala-style trust networks.
Fifth, foreign-denominated financial assets.
Holding debt or deposits in the currencies of nations that are structurally less likely to adopt the ABCD architecture aggressively. If your home country goes full surveillance CBDC, you hold the bonds of a country that hasn't.
Wow. Now, taking a step back, looking at these wildly different portfolios, it raises an important question about strategy. Why choose the exit vector path when the participant path offers the growth of the entire future economy?
Williams provides a fascinating real options framing graph to explain this mathematically, but we can visualize it conceptually. Imagine a graph.
Okay, I'm picturing the grid.
The horizontal x-axis represents the future trajectory of this architecture, from a highly favorable utopian rollout on the far left all the way to an extremely adverse confiscatory end state on the far right. The vertical y-axis is your wealth payoff. The participant investor has a payoff line that starts incredibly high on the far left. If the ABCD architecture succeeds smoothly and becomes the new global standard, their payoff is massive. They own the infrastructure of the new world. But as we move to the right on the graph, toward those adverse end states, say, a chaotic rollout, massive public rejection, cascading cyber failures, or a systemic collapse, their line plunges dramatically downward. They face a devastating loss of capital. It is the ultimate high beta play.
High risk, astronomical reward. What about the resistance?
Look at the RB investor, the one buying gold, farmland, and self-custody digital keys. Their payoff line is almost perfectly flat across the entire horizontal axis.
Wow.
They do not get the massive upside. If the tech boom succeeds, they miss out on the trillions generated by AI.
Wow.
But if the system turns confiscatory, if the CBDC grid fails, or if legacy assets are outlawed, their wealth does not drop. Their payoff is stable regardless of the macro end state.
And the RA investor?
The RA investor, the one who just avoids the tech but holds normal stocks, has a slightly lower but also relatively stable payoff line. They trade maximum upside for stability and moral coherence.
Which brings us to the final major piece of this puzzle, and frankly, the most explosive immediate consequence of this paper. This is where the academic theory hits the hard reality of the law for anyone who manages other people's money. The paper highlights an unresolved fiduciary duty tension.
This is a critical legal and structural conflict that is brewing right now.
Yeah.
Let's look at modern portfolio theory, or MPT.
Okay.
By law, under frameworks like ERISA in the United States, pension funds, trustees, and institutional fiduciaries are legally mandated to spread risk across the full investable universe to maximize risk-adjusted returns for their beneficiaries. It is a long-established, ironclad legal standard. You cannot arbitrarily exclude highly profitable sectors of the economy without violating your fiduciary duty to make money for your clients.
But wait, we just established that a massive chunk of investors, the resistance, might demand categorical exclusion of these ABCD assets based on their deep moral, religious, or practical values.
Exactly.
I mean, think about your own retirement account right now. You have trusted a fund manager to grow your life savings. By law, they have to maximize your returns. But what if doing so means they take your money and fund a system that tracks your every movement? Or violates your religious beliefs? You are going to call them and say, stop, take my money out of those biometric companies. And under current law, they are legally going to have to tell you, I can't.
You've hit the nail on the head. That is the unresolved tension. Beneficiaries are going to demand values constraints, especially in faith-based institutions, privacy-focused nonprofits, or libertarian enclaves. They will explicitly say, I accept reduced diversification, I accept potentially lower financial returns, because this principle, not funding a surveillance state, is more important to me.
Right.
But the legal frameworks governing fiduciaries haven't caught up to this bifurcated reality. If a fund manager honors the client's morals and the portfolio underperforms the AI boom, the manager can be sued for breaching fiduciary duty.
So it's a legal catch-22. The fund manager is trapped between the law of maximum return and the deeply held values of their clients.
Yeah.
How do we solve this? Because this isn't 10 years away. This tension is starting right now with ESG, and it's going to explode with AI and CBDCs. Williams provides recommendations for 4 different constituencies. Let's start with policymakers. What is the advice for the people designing the system?
The paper advises policymakers that design defaults matter. If a central bank designs a CBDC and a biometric identity system with maximum surveillance, zero privacy, and highly restrictive programmability, they're going to artificially inflate the size of the resistant cohort.
Yeah, people will freak out.
Exactly. People will panic and flee the system, capital will migrate to exit vectors, and social trust will fracture. If policymakers make surveillance moderating choices, if they build in privacy by design, perhaps using those zero-knowledge proofs we discussed, they dramatically improve voluntary adoption and reduce systemic friction.
Next, asset managers, the folks running the mutual funds and ETFs.
For them, Williams points out a massive, glaring commercial opportunity. The supply of operational instruments designed for the resistant investor currently lags way behind the likely demand. There is a fortune to be made for the first asset managers who create highly audited, screened mutual funds that guarantee absolutely zero ABCD exposure, or institutions that offer specialized, insured exit vector custody services. There is a whole market of alienated capital waiting to be served.
Third, institutional fiduciaries, the pension boards and trustees.
They need to prepare for this demand for categorical exclusion immediately.
Yeah.
They cannot wait until the AI boom is fully integrated and beneficiaries are protesting outside their offices. They have to engage with this MPT versus beneficiary values tension now. They need to explore legal safe harbors, draft new mandate structures, and figure out how to offer compliant exit pathways before the legal challenges begin.
And finally, individual investors. That is you listening to this deep dive right now.
The recommendation for the individual is to achieve clarity. Choose a coherent position from this framework. Look at the menu of the future. Assess your own predictions of how this macro transition will play out. Decide if you are a participant who wants to build and profit from the new machine, or if you are a resistant who needs to insulate your wealth from it. Align your capital accordingly. The worst place to be during a structural transition is caught in the middle without a strategy.
Let's summarize the immense scale of what we've unpacked today. We are looking at a blueprint for a future where artificial intelligence, fully programmable state digital money, and biometric identity could fundamentally split the financial world in two. It is a landscape where you can no longer just passively invest and forget it. You actively have to decide whether to fund the new machine, to be a loyalist riding the wave, or a voice shaping it from the inside, or to buy the farmland, the gold, and the cryptographic keys to escape it entirely. Thank you so much for taking this deep dive with us today. And remember, while this paper treats all of this as an academic contingency, a what if, the technologies we discussed today are already being built. The central bank ledgers are being coded. The biometric scanners are in your pocket. The pipes are being laid.
It is a profound, perhaps unprecedented shift in how humanity interacts with value. And, I want to leave you with a final unaddressed question that extends naturally from Williams's text.
Okay, let's hear it.
If this ABCD architecture succeeds globally and all money becomes perfectly programmable, instantly settled, and flawlessly identity linked by AI, what happens to the concept of human trust?
Wow.
For thousands of years, finance has relied on a degree of interpersonal trust. If every single transaction, every promise, every contract is guaranteed, monitored, and mechanically enforced by an artificial intelligence and an unforgeable biometric scan, does human trust become obsolete? If you never have to trust anyone because the code forces compliance, do we lose a fundamental part of the human social fabric? Or will we simply invent entirely new, invisible ways to trust each other outside the financial system?
That is a fascinating, chilling thought. Are we engineering the very need for trust out of existence? And if so, what takes its place when the computers manage our morality? As you look at your own portfolio today, as you think about that murky diagnostic X-ray of the future we started with, ask yourself, am I a participant or am I a resistant?